Okay, good afternoon, guys. We'll start a few minutes early today. It's a cold day here, so I need to warm myself up, keep busy. So another live training clinic today. We're going to focus on the Bank of England. We're not expecting any fireworks at the Bank of England, but as I've explained many times, it doesn't matter what the market's expecting, and it doesn't matter, if the interest rate decision today is unchanged. What we're expecting to see is some movement and some speculation around the event. Interest rates are going to go up. Doesn't matter what anyone says. Doesn't matter what the ECB, what the Bank of England, what the Fed kind of think and do, and what they say to the markets. Everybody knows it's absolutely inevitable. So I've been saying that UK rates are going to rise first, and I still think that's the case. And I'm still pretty confident they're going to open the third quarter of this year. And I might be wrong, but it doesn't really matter, does it? I've been right about a lot of things over the years, and it doesn't mean that I'm necessarily a better trader for it. It doesn't mean I make more money from it. It just means that I understand how I fit into the trading world, my views, my fundamentals, my technicals fit in, and I've got a rough idea of what's trying to be achieved by the market. Then I'm probably a lot further ahead than a lot of traders out there that is trading levels, jobbing around. So again, I've been saying for a long time the euro, in my kind of eyes, is finished. We've still got these problems with Greece, this new political party that's coming to power. Had a big move overnight with some comments that came out from the Eurozone saying that Greece, no matter what, had to stick to its debt repayments. There'd be no haircut. There'd be no, bonds linked to growth and all that kind of stuff. And they had to pay. They couldn't leave the euro. They had to pay. So a big spike in gold and a big sell for the indices. We're kind of back to parity now. But these are the things you need to be aware of. And if I was in Greece and I could see there was really no hope and there was no kind of real. No kind of sense of, what's in it for me type thing, kind of what's in it for me being in the euro. It's done nothing, for a whole generation of people. And, I think it's time that people are going to vote with their feet and just say, you know what, we're right off the debt. And if we fall out with Europe, we fall out with Europe. But go back to the drachma and we'll go back to tourism and we'll all be happier for it. And there's nothing the European Union can do about it, literally nothing. So I'll be amazed if this time next year the euro is still intact. And once Greece bail out, it's going to be Spain and Portugal. I think Italy might not, even though they've got big debt problems themselves. I think for different reasons they'll stay in the euro, and I think Ireland will be fine. I think they've come out of the worst of it, but Greece, there's no way back for Greece. So it doesn't matter what anyone says. Greece is going to leave the euro, and it'll be. There'll be no friends, left after this. It'll be a dishonourable default on debt, and it'll be carnage. And the euro will go down to about 0.8, and that's really where it should be, to be honest. And that probably won't do anything for the eurozone, any favours for the eurozone. But it's the way it's going to be. The 60 billion of euros of quantitative easing is just basically throwing good money after bad. It's just ridiculous. And, this idea that Germany can prop up the eurozone single-handedly it's laughable. So Mario Draghi lost a lot of respect for the guy, to be honest. And, again, when you talk about quantitative easing and Ben Bernanke, I do respect when he brought it in. His best argument was quantitative easing, well, technically it should work. That was it. That's how he sold it. That's how he sold $1 trillion worth of debt to the US public. It should work. And Mario Draghi just copied him. And with not even with that saying it'll work, he's just done it because the guy doesn't know what else to do. So really going to be interesting how things move in the Eurozone and the UK. And obviously, the United States. We're going to have to see what happens when, interest rates finally go up. And it's cyclical. It doesn't really matter, when it happens. People that have a mortgage, over the last 10 years have still got 15, maybe 25 years for it to run. So interest rates are going to go up, in 2015, 2016, 2017. They're going to have to. It's cyclical. There's absolutely nothing can do about it. And when they go up, we know in the UK especially, we've got 1.2 trillion pound of personal debt. But we've also got about the same amount of money tied up in property. So this idea that your house, you're king of your castle, all that kind of stuff, that's going to keep you in retirement. It's all nonsense. So house prices are going to take a massive hit over the next 10 years. I don't care what anyone says. It's going to start in London, and it's like anything. Oil prices. You talked to me about oil prices last year, and we're at $115 a barrel. People say, "Oh, it's never going to go down to $40." Nah, that'll never happen, Steve. You're mad. And it happens. I said it'd get down to $43. So I wasn't far wrong there, was I? I said gold was going to get to $1,000 by this time 2 years ago in 2013. I said that. And we're not there. Okay, I've missed it by a couple of $100. That's only because of the unforeseen circumstances in Russia and the Swiss, etc., etc. But gold's getting down to $1,000. It's never getting back to 1900. It's as simple as that. So I'm closer to my target than these muppets that were saying it's going to get to $5,000 or something. So again, it's about being realistic about understanding supply and demand and how the world works. It's in no one's interest, really, for gold to be overly expensive because UK has none and Fort Knox apparently is empty. So what's the reason for keeping gold high? There is none. So getting back to interest rates and what we're going to expect today. Well, we're expecting no change from Mark Carney, but there could be a change in the asset buyback. That is probably the only thing we'll probably try and really focus on. That's 375 billion that we're still purchasing back. But really, it's the tones. Like I demonstrated from the Fed when I traded on FX Street last time. Nothing was changed, but there was a change in the sentences, and again, all these different words that are said and how things are presented. Being patient was kind of removed, and that did send a ripple through the market. So that was kind of, I took it as a quite a dovish thing that the US economy was strong enough to potentially talk about bringing rates up and normalising the economy. And we were short gold, and we saw a massive spike down in gold, and we made a bit of money. So again, it might not have been because of that, but I was prepared. I had a view, I had an understanding, I traded, and I made money. And that's what I do. I'm not interested about particularly being right. Being right is a bit of a luxury in trading. It's being about right at the right time and making money. So I've been jobbing away at the markets. I've been focused back on my trading because I don't know. I think for the main reason, I do a lot of theory, and there's only so much theory you can do, and I get a bit bored of theory. I've kind of taught people everything I can about trading. Well, not everything, because you can't teach everything, but I've done a lot of theory, and now it's going back to basics. So I've made about £4,500 in the last 2 weeks, trading a £5,000 account and trading between 3 and 12 lots. Okay, so as simple as that. Just jobbing around, nothing too big. I've taken £1,300 hit on the Nasdaq, trading fundamentally and ignoring my technicals. Took a big hit, and then did 22 trades in a row, 3 lots, and then made all the money back. And I've gone on to be, again, more profitable as the days have gone on. And that's not trying to say I'm some genius trader. I'm great. I'm not. What I'm saying is all the things I teach. I teach what I preach. So if I say you take a big hit on a 20 lot size, you go back and you make it back over 4, 5, 6 days, or a couple of trades, or a couple of days, and you make it back in smaller size. So that's what I've done. I've got the proof that you make it back doing that. And then I've gone on to be more profitable by trading. Okay, I've had a couple of losing trades, but on the whole, they've only been a quarter of what I've made on a day. So I took a bit of a hit on gold the other day. Didn't matter. That money back, made some more profit. And that's what trading is. You're going to lose in trading. You're going to have the bad off day. I mean, I'll show you the charts in a minute, what I was doing this morning. And I was wrong, but I still made money. And that's what trading is, getting out for some profit, even if it's not the max profit you want, but then avoiding them losses. There's nothing new in trading, guys, and you can read my book when it comes out, and it's brutal truth, absolutely brutal truth. And if you don't like it, don't read it. And if you don't like it and you don't like what I'm saying, don't trade. Okay, there's only so much I can do. I want to teach you anything useful, Phil. Well, when you made as much money as I have in the markets, Phil, everything's a bit of gold dust, to be honest. So I'd probably just leave the chat alone and listen to the experts. That's why I'm presenting. I've got the microphone, and that's why you're turning up listening. Anyway, before I start, risk warning. Remember that spread making securities trading carry high risk or capital, confronting losses they see initial deposits. It may be suitable for everyone, so please ensure you fully understand the risks involved. The information comments provided here under no circumstances is an offer solicitation to invest. Nothing in is due investment advice. Information provided believed to accurately is produced. Education only. Content of the webinar is spirit of moderator at trade.com. Content is not constitute financial investment or tax advice. In trade.com, it's not accept any liability of the content of comments made during the session. So I'm going to go over some live charting analysis, multiple time frame trading, so I'll show you the technicals that I use in order to get an idea of what the market's trying to achieve. I think you'll find that pretty useful, Phil. So fundamentals, we're going to focus on the fundamentals being the Bank of England. Again, if you don't know what that's all about, you shouldn't be trading. Live money trades, I only trade live money, and there we go. And Q&As, yeah, anything. This is an open session, so ask what you want. Don't ask stupid questions like Phil, because I'll boot you out the room. But, if you ask me your proper intelligent questions, then I'll give you a proper intelligent answer. Because that's what we're here to do. We're here to learn. So, this is the gold, for instance. So I can see the indices were looking, again, by having this kind of Sorry, by having this kind of view, you get a bit of a balance of what the market's trying to achieve. So I've got the DAX here, we've got the UK, and we've got the S&P. Okay, so we can see, the S&P kind of doesn't open to the afternoon, obviously, but we've got how the markets, the UK and Germany are trading in the morning. So we try and see a filter and a pattern of what's going to happen in the European markets through to the US. So as the indices, were gaining strength and getting, support on this 50% fib and getting to these resistance points, gold was obviously going to take, a little bit of a tumble because the inverse correlation, as stock markets go up, gold and safe haven should come down, right? So, all these things that have a correlation. So when you're trading the indices, you want to be looking at some currencies. When you're trading the currencies, you want to be looking at indices, commodities, and other things that have a correlation. So we're right at the bottom of this formation here on the Fibonacci's, on the hourlies. So you can see how the market hits resistance, hits the 50%, and then as it hits that 50%, it closes below it, rejected several times. We know the market wants to get down to these lower fibs. So we got all the way down to the 423 and had a little breakout. So I bought gold here. I was expecting just to dig back into the range and just got out up here because I wasn't feeling right. And as the indices remained to carry on strong, I didn't go short gold. I just left it. But then gold obviously broke down this lower fib, being very, very bearish, and then broke to the lower Bollinger Band. So as the indices increased in value and demand, then obviously gold took a bit of a hit. So really the trade was to sell. But again, based on my kind of technicals and my view right now and what happened overnight, I was just doing a little cheeky buy of gold. So just £100 made here, nothing major, nothing that's going to change the world. But, again, it's still profit. So it's still banking profit. And I got out and didn't take any of this downside risk on. And it's not because, I'm particularly bullish or bearish gold at the minute. My trade idea was to get long at this point and to see if we could break back towards the 50%. And we didn't. I took some profit out. And the right trade, yeah, sure, would have been to sell. But hindsight's a perfect thing. I still made money and didn't lose money trying to buy it aggressively when it was coming down. So, again, it's like everything in trading. You can have the right opinion and make a little bit of money. You can have the wrong opinion and make a little bit of money. Or you can have the wrong opinion completely and lose lots of money. And I didn't do any of these things. I just made a little bit of money. And the trade to do was obviously sell. But, that's that. I didn't have that picture in my mind as that's what I wanted to do. So it doesn't mean that, you're a good or a bad trader if you don't get it spot on. It just means that you didn't have the right opinion at the right time. So maybe, gold's a better buy down here. Kind of this 1521 40 level, or maybe it's going to continue to sell off to that point. I don't really want to sell it off, to be honest, because I think the indices are due a correction and a little bit high, and they've got to sell off towards the non-farm payroll, because I'm not expecting a good non-farm payroll this time around. So I'm expecting the indices to go off and then gold to, come back up to these upper levels. I mean, still, my longer-term view of gold is going to go down to $1,000. Again, we can see every time we make these highs, on the hourly charts, we go down. And the monthly is absolutely, perfect. Here's a little bit of gold dust for you, Phil. What are you wittering on about now? Nothing else to do. Nice. Well, what an interesting guy you are. Well, here's a blank chart. Here's some gold dust for you. Market's gone up from the lows to the highs. So we were trying to understand where value is in gold. Well, it's at that 50% on the monthlies. So look how 80% of the time a strong directional move will retrace to 50%. So we've gone all the way in this bull move, from May 2008 to, kind of like late 2011, then the market again has made significant lower highs and it's coming down in quite an aggressive manner. And we've hit that 50%, yeah? And look how the market's reacted around here. It's gone all the way down to that 61.8, found perfect support longer term, then got all the way back to that 50% to the point, to the absolute point at 131032, and then he's now looking to move back down. So again, for me, $1,000 is where gold should be and find some real value. So this is how we're starting to build up our picture, making these lower highs monthly. Look at your weekly chart, again, a lot clearer now. Lower high, still coming down. So again, we've seen that relief, all that fear, pushing gold up, and now we're coming back. So your target is 61.8, round about 1183, and a break below that will be to our $1,000, I think, longer term. So again, what you're doing is monthly view, weekly view, daily view. A daily view, again, you can put another type of fib. You see, the market has gone from here to here. So what you're looking for is the fib now, more intraday and shorter term, to start finding resistance on the 23.6, 38.2. And now your pivot is this 50%. Okay, so your 50% is here, down at 1, 2, 3. 1237 spot 50. So what we're looking for now is the market to find resistance on these points, to break these lows, and then hover around the 50%, find eventual resistance, and then bang, down to these lower fibs, down to the upper fibs that we've seen from the monthly, and then, again, getting down to the 161, which is edging even nearer to that $1,000 mark, that 1080. So that's how you build up an all-time frame method and picture of what the market's trying to achieve. Go from the monthlies to the weeklies to the dailies, and then trade on the hourlies. Okay, and then that's really what we're trying to do. Find out a framework of what can happen based upon the past. Yeah, and then go through to your weeklies, build a picture, see if it's supporting what you think, go through to the dailies, and then again, I always jump onto the hourlies. And again, if you're looking to sell gold to get to $1,000, we look for either break points or, to sell high. And, again, every time we've got high, gold has seemed to be coming down over the last few days. So again, in hindsight, the trader did here may not have been the best trade ever, but, it doesn't really make any difference, does it? Made a little bit of money. And, I didn't get caught on the down move. But, my kind of thinking was, with all these problems with Greece and, the possible defaults, not being on Greece's terms and the risk of them pulling out the Eurozone, ever increasing, then gold might take a bit of a bid. But it didn't. You see, this is a technical move, how this support resistance line worked. The market broke out, okay, tried to make it back, but then the up move tested where it had broken. So that's how you know it's a technical move, not a fundamental move. Yeah, because it came back, because fundamental moves move with direction and maybe gap and never test back to the entry point generally. So this is a technical move where the support, resistance, we've come back on the way up, way down, and then the market's gone on to make new lows. So you're looking for the market really now in gold to get down to 125, 410, and then maybe a break below. Who knows? Again, it's for whatever reason, technically gold is now selling off a little bit. So that's gold, and that's the trader did this morning. So let's just put that back. Okay, so looking still fairly weak. But then you see, the correlation is the indices were going up and then came back down. So that was dragging gold up, but then gold, sellers have used that to get a pile into short positions, then push gold down because, the indices are coming off the highs and gold's making new lows. So it just goes to show these correlations, are whimsical. They don't always work absolutely directly and indirectly, and they pick and choose when these correlations, actually kick in. So you have to understand really what institutions and the big traders are doing and the people that are smart, what they're doing, because, they're the people that really drive the markets. So it's understanding the technicals, fundamentals, and then using your own interpretation to what can be achieved. Okay, so any thoughts on... Okay, so let me just go through some questions. So any thoughts on the euro, Japanese yen? Okay. Could we have a look at the pound against the dollar? Do you see another leg down? Okay, right. And could we have a look at the pound dollar? See another leg down? Yeah, okay, right. Well, the pound against the dollar. Again, my kind of longer term view is the dollar's not really going to go out of fashion anytime soon. So I'm always going to be buying the dollar, and I'm always going to be selling the euro against other currencies. So when we look at the charts, we can see this dollar strength. It's really emanated from back in September. The market really kind of got on a bull rally. We made this very nice symmetrical triangle and, that kind of pennant type formation. Then the market's gone up. So realistically, we've got, look at the dollar, Japanese yen here. I'll go back to the dollar pound in a minute. But, again, we're just seeing dollar strength against, Japan in, for a number of different reasons. These emerging markets, don't seem to be as solid as we once thought. These these growing economies that have these huge GDPs and huge, kind of year-on-year growth of like 4, 5, 6%. It was always going to be unsustainable. So, if you're a billionaire, or whatever, where you're going to put your money. If you're an institution, where you're going to put your money. Well, it's not really going to be in, the kind of the yen, is it? It's going to be in the more stable currencies, which seems to be the pound and the dollar. So we've seen a lot of dollar strength in the currencies in general, but not much so more than the Japanese yen. So I think, again, we're going to see the same formation on the monthlies. So we're going to get some consolidation around here. But as long as we don't dig back into this body or this body here, then there's going to be more bullish movements. And I think these highs up at 134 are certainly going to be achievable. So let me just go into the dollar pound. And it's the same kind of scenario. I think realistically we're running out of momentum for the selling pressure. So I think we're going to see a bit of a rise in the pound from now on. If you look back at the monthly charts. We've had that 1, 2, 3, 4, 5, 6, 7 months of selling. So it doesn't matter how you interpret the charts. After 7 months of selling, you're going to have to see some green at some point. That's just how markets work. So I think realistically, I think we've bottomed out now. Interest rates are going to go up in the UK before the US. So that means foreign investment, foreign money is going to flow into the UK. So I think this top here was really kind of triggering the institutional bigger traders to sell off, knowing that people and retail, a lot of people are going to get long the pound, expecting a break up here, and then they're going to, force it down as low as they can, anticipating after the election that interest rates are going to go up, so more demand for the pound is going to be seen, and then really, anticipation of that, we're going to see the market rise back to 158, and I think quite easily by midpoint of this year, halfway through, we're going to be trading back to 164. So we're going to see 7 months of selling in reasonably fashion way, but then buying, consolidation, and then probably one solid month of buying back to 164. So the pound's going to gain a lot of strength very, very quickly against the dollar. That's what I think. I mean, again, when you look at the currencies, you have to look at the basket. People don't generally, or institutions don't generally trade currencies on their own. They trade them in baskets. So people will be trading, the euro dollar versus the dollar yen in huge quantities. We're not talking about, £1,000 trades, £1 million trades. We're talking about hundreds of millions of pounds, positions that will be taken, and they're all hedged against each other. So I think for me, realistically, the pound is too low, so the pound needs to strengthen. I think the dollar's pretty high, but it's going to remain high for some time. We've got all these correlations with the dollar and oil, and everything's a little bit out of sync. These natural correlations that people look at just aren't working. The correlation between the dollar and gold, the correlation between oil and the dollar, they've just been blown out of all proportion because of the quick moves we've seen. And the reason why oil's coming down is nothing to do with fracking. It's nothing to do with people thinking we don't need oil anymore. Oil's an absolutely inelastic product. It's going to be around for hundreds of years yet because we haven't found a reasonable alternative. The reason why oil has been smashed down is because we can't bomb Russia because they've got just as many nukes as we have. So what we're doing is we're taking them off of the legs. We're taking them out of the equation by stealthily destroying their source of income. The same with terrorism. The same with Syria and stuff. If we make oil less expensive, they make less money, less demand. So really, it's a short-term political move to bash out the people we don't like and we're not getting on with. So really, it's just it's a political consequence. And I don't think it does anyone any harm to shave the price of oil down a bit. It helps with the CPI, PPI figures. It helps people's standard of living, and it makes people feel a bit better about themselves. And so what? The oil industry's lost £500 billion. Who cares? I don't care. Do you care? Do you care about BP's profits? Do you care about these chief executives on 10 million quid a year? No, I don't. It's just a natural thing. Things go down, and sometimes they go up quicker, and sometimes they go down quicker. That's just the way things go. So I've seen that sell-off in the DAX now, again, getting back to these lower daily levels down here. So that 50% pivot, again, by understanding your technicals, very, very nice how these fibs have worked. Hit the upper resistance points. We get back to that 50%, acts as perfect support and resistance, comes down. Yeah, it gets all the way down to that 161, back up to that 50%, and now back down. So if you want to be a technical trader and use things like Fibonacci, then these things are absolutely perfect. The DAX is trading perfectly from a technical perspective. So a break below here and this daily level, we see the DAX get down to 10,782.62. We bounce off this, it gets back to the 50% at 109.2315, and then it goes on to make new highs. It gets to 11024.84, brand new highs. So that's what's going to happen. So set your risk reward around. Think it's going to go high. You can do an 80 tick stop to make 120 to make 180. There we go. Or you can get short, maybe put your stop probably back here. So 22 ticks to make 80 ticks. So a 4-to-1 risk reward ratio there. Very nice. I'd take that all day long. So again, we've seen this big green candle, so you have to expect a little bit of kickback and some consolidation. But then, the move might continue down. So maybe flick on your 15-minute chart to see how that happens. Okay, so 1, 2, 3, 4, 5. Red candles, maybe we see, blip back quickly to 1088, or maybe some of these support lines here, a little bit of green before the down move continues, or maybe this is the bottom and the up move continues. So again, it's finding value based on the time frame and what you're trying to achieve. That's trading, that's how we get involved in the markets. It's not about being right, as I said, thinking the DAX might fall 200 points today. It's about being right at the right time, getting in and out with your profit. That's what trading is. Trading's a marathon, not a sprint. It's taking a number of small winners, compounding them, and then keeping your risk-reward ratio the right way. Because you can lose every other trade, 50% of your trades. But if your risk-reward is 3-1, 4-1, you're going to be profitable overall. And that's how winning's done. That's how trading's done. So what else do we want to look at? I wanted to look at the euro Japanese yen. Okay, I'll look at that quickly. I don't really ever trade this particular pair. I kind of stay away from the yen in general, to be honest. I like to keep an eye on it, but I don't like to trade it. So euro Japanese yen. I mean, the euro, it's seen a little bit of strength and resurgence at the minute, but it's technically going to get down to parity and it's finished. It's as simple as that. So seen a bit of resurgence, a bit of a bounce in the euro against the Japanese yen here. So again, immediately I can say that this down move here has got to 50%. So I'd say, from the highs to the lows here. Well, is that 50% here? So again, it's telling us that there's we've got back to that 50% of the down move. So really, we've got a pivot point here. We've got this pivot point of the 50%. That we're either going to see the euro break back down here and then make some new lows, from this down move that we've seen here, or we're going to continue this up move and make some fresh highs here. So that's the hourly view. I mean, if we go back in the charts to the to the monthly, then we've seen a big drop, consolidation, big drop, and again we're above the 50%, so it's still looking fairly bullish, I would say, for the euro against the Japanese yen right now. So that 50%, we came all the way down and sold to it, rejected, closed, and went green. So from your bigger term picture, it looks like for now, that might change, that the euro is going to continue with this bull movement here. We've gone up and then down. So what we're looking for is an intraday way of buying low and getting high. So we're expecting these highs to be broken and tested. Difficult one because my fundamentals are screaming to me that I would rather buy the Japanese yen than the euro overall. But then I'm not an expert in the Japanese market. So my intuition would say, leave it alone, Steve. I don't understand the Japanese market. I don't really want to buy the euro against any currency. So I'm really not going to start buying it against the Japanese yen. So even though the technicals are saying, okay, we've had this big sell-off to the 50% and bounced, if I don't see a good enough bounce here, I still predict that the euro is going to weaken against every currency. And that includes the Japanese yen. So I think really, if we close below 132, spot 290, we've got a lot of downside room on the euro against the Japanese yen still. So going through your weeklies, again, seeing been fairly steady buying, when we've seen that, the market kind of consolidate downwards and then have this spike up, but then it was quickly, again, sold down 1, 2, 3, 4 weeks. So we don't see a significant bounce on the weeklies, then I still think there's a lot of downside room and maybe getting down to 112, these kind of areas down here. Then the dailies. Again, look a lot more bearish now, don't they? From the monthly and then the kind of weekly view. So we've come up all the way up here, consolidated, and really every time we've seen any kind of action, it's been from the downside, from the sell side. Every green candle's relatively small and short-lived, and then the red candles are selling off. So I'm expecting some consolidation here. So again, look for that 50% pivot on your hourlies, perhaps, and see how we trade around that. And if we start to, not really kind of make any attempts to go back higher to these upper levels, then maybe that's a good idea to start getting short and watch for a material break of kind of 132. And then I would expect the market to be trading, down to 122 and below that. So negative, everything is negative euro-based, I'm afraid, in my kind of fundamental view. But technically, you can make an argument for both cases, but I would say really look around that 50% on the hourlies, and for me, I'd be looking to sell high rather than to buy into any strength. So I'd be selling below 134.027. For me personally, I think that's where the value is, and I think we're going to see more euro weakness as the weeks progress, especially with the situation with Greece right now. All right, guys, well, 5 minutes for the Bank of England today. So interest rates, as we know, 0.5%, historically low, have been for quite some time now. But what we're looking for really is any rhetoric, any comments that come out of the ordinary after, the interest rate non-event. So if anything comes out, to do with, the asset purchase, or anything comes out with, any kind of forward guidance on when interest rates are likely to raise, if they're on the agenda to raise, if Mark Carney and the Bank of England think, things have changed, with regards to inflation, cost of living, the fact we've got an aging population, we need to have a normalised interest rate so people get returns on the money. All these things, real world scenarios and what the Bank of England bases its decisions on. It's not simply as that, we want to keep interest rates low because it's good. It's not. Keeping interest rates low is bad. We need to have normalised interest rates so that everybody benefits. So we've got 4 minutes or so before the Bank of England come out with the rate decision, guys. Have you got anything you want to go through finally from a technical perspective before we just focus on this announcement? So, sell off in the DAX, bounce off, these fib levels working quite nicely, gold towards the bottom of the range. So again, these lower Bollinger Bands kind of acting on the hourlies as a nice bit of a cushion. So, yeah, I'm overall bearish gold, but I think we could have a little bit of a test higher, to be honest. Okay, so yeah, I mean, I think just go back to some questions higher up. Sorry, I missed a couple of these from Black Cat. Do you think the Fed will hike rates this year? I think they can, and you hear kind of different things from the Fed's Bullard and from Yellen herself saying that. That it's like two conflicting views. It's like there's no hurry to raise interest rates. We've got to be patient, but they can be raised at any time. That's the message I get from the Fed. So they know the interest rates are going to have to go up at some point. It's just that timing element. So it doesn't really matter if it's third quarter or fourth quarter of 2015. It will certainly happen in 2016. So I think a lot of it's just a waiting game, really, and just putting off the inevitable. I think the Fed definitely, as the UK does, has scope to raise interest rates by about 50 basis points by 2016. They both have the capacity to do that. It's just if they will. They both certainly 100% can raise them. There is the tolerance in the economy, and there is the growth figures in jobs to support it. The problem is just personal debt, and that is people's mortgages, people's personal credit card debts, loans, etc. That's going to be the killer, and nobody knows. Nobody has any idea what the effect's going to be. Nobody, and that's why people are so frightened about putting interest rates up, because they don't know the fallout. They don't know what's going to happen. Is there a valid thesis for more QE instead of a Fed rate hike? It's so difficult, isn't it? I think the Eurozone have got it wrong. I don't think there was any need for this quantitative easing. I think what they should have done is done something a lot more adventurous, a lot more daring. But what that would be, I don't know. So quantitative easing hasn't broke the world, but it hasn't fixed it. So what does the Eurozone think is going to happen? It didn't break the US, but the US is a different kettle of fish. But it hasn't fixed the US, has it? So I think really it was just lack of ideas and nothing else to do. I would say, QE instead of a Fed rate hike are two separate things. The Fed are going to raise rates at some point because, the US needs, with its aging population, a normalized interest rate. And that's the way markets work. We can't just, encourage growth by keeping interest rates low. It hasn't worked so far and it won't work in the future. That ship has sailed. All right, guys, just a minute now to the Bank of England, so it'll be probably unchanged. But we'll listen for that 375 billion asset purchase if anything else happens. So got the trading account open. If I see anything interesting, I will trade. But I'll be probably focusing on the FTSE. So I'm looking for any kind of positivity to buy low into the FTSE and carry on this bull trend. But then watch gold as well, because gold's a bit of an animal on these things. 10 seconds now, guys. Expected unchanged. Unchanged. Just listening for comments now. 375 billion for the asset purchase, so absolutely bang in line. So unchanged, the asset purchase remains. So is that good news for the UK? We're going to see the FTSE rally a little bit on that. Okay, goals just towards the low points of the Bollinger Bands, but I guess relatively good news, and everything in line could send gold down a little bit. But just generally see the market move in the opposite direction it's going to before the true move happens. So we could see a little bit of a down move in the FTSE down to this lower level here at 6829 spot 29, maybe a bounce up. We're seeing gold just kind of get a little bit higher, maybe it then comes back down. Mohan, FTSE to reach 7,000 this week. Well, I think it's got every opportunity, hasn't it? I think the FTSE, as I've been saying, pretty much all this year, since the DAX at 10,000 and is way above it, getting towards 11,000. The S&P is holding above 2,000. The fundamental and psychological levels in the FTSE have to be hit. So if the FTSE doesn't hit 7,000 in the next couple of weeks, then it never will. And I'm 95% sure that the FTSE gets to 7,000. And that's just based on what the rest of the indices have done. So everything's unchanged there, so no real reason for any of the indices to go heavily bearish and negative on that if everything's unchanged. No news is good news, so maybe we're just going to see a little bit of a push down before the markets continue this up move. And gold, again, as long as it doesn't get back to 50%, I would say, of this down move here on the hourlies, then you've got good shorting opportunities. So I'll probably be selling, either buying gold to that 50% might be a good idea, or then letting it get to 50% and selling and letting the market continue this down move here. So again, two ways of looking at it. Just because I think it might get to 50% doesn't necessarily mean I want to buy gold up until that point. But, again, it's different ideas. You'd say that really, for me, the kind of indices are looking still fairly strong. When you look at the S&P, although it's, doesn't really kind of trade that actively in the morning, we're still green, heavily green. Yeah, tried to sell off here, absolutely dojied, and no decision, then up and up. So rejection on the low side here. So we're definitely going to look to get to 205, spot 73. So that should drag the indices up. So we're looking for low points in the FTSE and low points in the DAX to go the highs. And then if gold's going to go up to 50%, that's fine. I'd probably sell it at the 50% for it to come down if the indices are going to carry on that bullish movement. So he's trying to pick out what you think of all these charts. You can see where the value is. So it might not be in the DAX, it might not be in the FTSE, it might be in gold, or it might be in the euro dollar. Again, it's trying to figure out from what you see, the data you see, from the fundamentals we're looking at, what's the best thing to trade. Because I can't just say, well, I think the FTSE, the indices are going to go up, so just buy. That's not how trading works. You're looking to get the minimal amount of risk you can, the minimal amount of downside exposure, and then pick the product that's going to yield the best results. So I might think that the DAX is going to set off and quickly break these highs. So actually, the FTSE goes down, I'll buy some FTSE rather than the DAX. It kind of sounds odd, doesn't it? It sounds, if you know where things are going and what they're going to do, why don't you just do it? Well, because it's about taking that amount of risk on and taking the right kind of a portion of risk to trading. So I might only make £300-400 today out of my trades, when I could have just bought my entire account, longed the FTSE and expected it to 7,000. But the risk I'd have to take on is much greater, okay? But if I job around the markets, take little bits of risk on and make small amounts of money, it compounds and you make more money. So that's why I've made £4,500 over the last kind of 2 weeks, which to me is pocket money, guys. I mean, anything to me. I don't care. But I can't trade, a £300,000 account in these kind of sessions, because it won't give you the benefit of, you wouldn't be able to do that necessarily. You wouldn't want to do that necessarily. And, that's not what I'm trying to teach here. I'm trying to teach anybody can make money from a spread betting account and starting with a reasonable amount of money. So I'm trading just like you guys on a spread betting account. I'm using MT4 charts and I started with $5,000. Okay, so anyone can do that because it's all free, and $5,000. Well, it's just $5,000, isn't it? It's not a lot of money. And I'm trying to prove, that I what I teach is what, you should do. And if you do that, you should make some money. So I take very small amounts of risk on. I'm very selective about my trades. And when I'm right, I make money. And when I'm wrong, I get out for a reasonable loss. I mean, that's the secret to trading. There's no more mystery to it than that, I'm afraid. Okay, so unchanged. Cable is not moving. My platform was freezed. What's a reasonable amount to start with? Well, I mean, I think a reasonable amount to start with, is probably £1,000. £1,000 will buy you a bit of time. It'll allow you to average into trades. If you start too small, you've got nowhere to go. I mean, you start with like £200, £500. Realistically, you're only one bad trade away from wiping your account out. So you need to buy yourself some time. So £1,000 buys you some time. You can certainly, with experience, make enough money to live off from £5,000. Ideally, from managing a lot of traders over the years, I generally started traders off with 10 grand. But then, when you're a professional trader, you've got desk fees and stuff. It costs you £2,500 just to turn up to a professional trading arcade. So I'd say realistically, if you start with £1,000 in your account, you've got maneuverability, and you've got the ability to make money and take the odd loss on board before you get consistent. It takes, in my view, about a year to be consistent charting. So, you need to buy yourself a year's worth of trades. That's the way I look at it. All right, guys. Anything else? So, we saw a little bit of negativity, but really, as I said, no news is good news. So we generally go in the opposite way first. So we got down to that lower level in the FTSE, now we're green. So we're green in the DAX, and we're towards the high in the S&P. So as I said, not really a great buying opportunity, to be honest. But what I'd be looking for now is really the markets to consolidate and tick up. So I'll be looking for a high point again to sell at gold. So I'd like to see a little bit of a spike up in gold to that 50%. And I'd be happier selling gold than I would be buying the FTSE, the DAX, or the S&P right now. And that's just it. That's just the way I'm looking at the markets right now. The S&P, when the market is being dragged by the S&P, and the S&P is not really kind of being traded because the US isn't open, it's very dangerous, because what you can see is the market drags everybody up very, very quickly. So Europe gets, this euphoric kind of buying in the FTSE and the DAX, and then all of a sudden we see, candles like this. Bang, no rejection, and it drags Europe back down. So because we're towards, the absolute highs, the majority of value is going to be selling high. But as I've said, we still don't have a better place to put our money. As the 1% say. So the indices are going to remain to go up. So I'd say the most value is going to be in the FTSE. Again, down these levels here. So if we do see the S&P break up and the DAX break up, the FTSE is going to be dragged up and eventually get to 7,000. So, bigger picture stuff, I guess, it's going to be, you're going to make more money longer term selling the highs in the indices, but short term buying, small dips at the bottom of the indices is probably, your safest risk reward type bet. All right, guys, anything else you'd like to ask or anything you'd like to do? What do you think will be interesting post NFP? Will it still be crude and CAD like this week? Well, I mean, the non-farm payroll expects another positive reading, but I don't know. I mean, again, I think in the US we've seen all the jobs created before Christmas, and again, a lot of part-time work and a lot of low-paid work. We saw that the non-farm payroll again was stronger than expected, but the actual hourly earnings keeps dropping. So people are taking more jobs on but earning less money. So it's kind of conflicting figures, just because there's more people working, more people paying tax, less people claiming, insurance. It doesn't mean that they're actually better off because wages are still, comparatively fairly low in comparison to inflation. So I think no matter what happens from the NFP on Friday, even if it's strong or if it's not, I still think we're going to see a bit of correction in the indices, because I don't really think, even good news is as good a news as the US needs. So it's kind of reading between the lines. The non-farm payroll, no matter what happens, is going to cause massive volatility, and it's going to cause, a lot of movement. But I think oil, naturally, once you've spotted the trend, you're too late. So we've seen this big bounce, but I think oil is going to head back towards $40, and then we're going to kind of consolidate around about $50 for a couple of months, and then by the end of the year, it's probably going to be trading $65, $70, and then it's going to stay about $65, $75 for quite some time, because you've got to think about who trades oil as well. 40% of money that's made in the commodity markets is by people like BP and Shell. They trade oil professionally, so they know the supply figures. They know they can control supply and demand. So oil's never going to stay low for any sustained period of time. And by low, I mean kind of, it's not going to get to $20, and it's not going to stay about, $20, $30, $40, $50 for any sustained period of time. It naturally will get to $60, $70, and it'll stay that way for a long time. It might not get to $115 for ever again, or, certainly for a good few years, but it's going to continually, probably sharply go back down again, for big profit taking and just by traders manipulating it. But then it will stagger and go back up towards the end of the year for sure. So it's not going to stay low for a long time. That's for sure. Steve, what do you advise you have for buying pound dollar for long term? Now a bottom, it's been reached. What would be a long point? I think I went through that. So 164. No, I keep doing that. Where's the? Yeah, sorry. We'll go back to the monthly. I mean, we've seen 7 months of selling, so obviously we're going to bottom out. We've got these big levels down here, but realistically, what I would suggest is that it's going to gain a lot of momentum very, very quickly. So these are good areas to buy because, as I've explained, the interest rates will go up in the UK first. Okay, so we've got negative deposit rates in the Eurozone, so you're not going to put your money there. If you're going to have, 0.75 interest rates in the UK, you're going to put your money there because you get a better return. So the demand for the pound is going to, increase the closer we get to the election and the inevitability of interest rates going up. So I would say 164 is a given this year. So, if you're looking for a longer term trade, then I put your stop probably about here. So 700 ticks to make 1,200 ticks, if you're doing a very, very long-term trade. So not a great risk reward on that one, really. But if you're going to get long here and we don't dig back into the range, then basically you just hold on. You'd hold on for 1,000 ticks. So I would say if you're going to get long anywhere around here, hold it for anywhere between 2 to 4 months. You should be looking at 1,000 ticks profit in the pound, I would say. Does that mean euro pound is a better short versus pound dollar long? As I've explained, the currency markets are different, and it's where you perceive value. I don't see a lot of value in the euro full stop, so I like to sell every high. But longer term, nobody knows what's going to happen, do they? I don't know what's going to happen in the future. I've got a good idea, but I would say if we're going to do anything longer term, are we buying the pound against the dollar and the pound against the euro longer term, because I'm pretty sure the interest rate's going to go up first in the UK, driving demand for the pound. So instead of selling the euro just because I think it's weak, I buy the pound against the dollar and the euro just because I think more action's going to happen and we're oversold. And my fundamental reasons for buying the pound against the dollar and euro are a lot better, a lot stronger, a lot more reasonable than selling the euro. So again, it's looking for them correlations. It's looking for what you're trying to achieve and where the best value is. And I think the value in the pound is there for everyone to see, both fundamentally and technically. Again, we might go green, sorry, excuse me, for this month, but then we might quickly go red and then we go up. But realistically, after 7 months of selling, you're going to have to see some profit taking and some buying back, because that's just how markets work. So, yeah, but a lot of value in the pound, I think, right now. And the closer we get to the election, the higher the pound's going to be, because no matter who wins, they're going to have to do something with interest rates, aren't they? They're going to have to increase interest rates at some point. So a little bit of strength, coming back into the FTSE, as I said, it wouldn't have been a terrible idea to buy it down the lows there. Again, would have had a nice little bounce or so. So really, it's just kind of waiting to the US session opening now. Are the indices going to remain strong? And if so, I mean, we've got to that 38.2 in gold. So I'd just like to see it quickly get to that 50%. And I'll be selling gold at that 50%, expected it to come down as the markets just creep back up. And it's, again, that's just really a kind of technical trade rather than fundamentals. I don't think there's a major fundamental reason for gold to go up or down, today, or for the news I've heard. But I just think that, this down move that we've seen gets to 50%, indices remain at the highs a little bit strong, and then it could be a nice continuation of this hourly big sell-off that we saw here in gold, get down to these lower points at 1254. Okay, when you say around here on GBP USD, I cannot visualize the area you're referring to. Could you mention that zone instead of pointing out it on the short? What we've seen a dramatic drop in the pound, okay, late 2008. And the market's consolidated, go back to the 50% near enough, but then rejected it and gone back down. So if you're looking to buy, you need to be buying low, okay? So let's see if you can understand this. All this area down here, yeah, is a good area to buy, because if we carry on selling aggressively, yeah, we'll go down quickly, but we won't stay there for very long. All this area here is where the market wants to get back to. So between 161 and 173, okay? Right, so we're on the lower fib here. So if we don't make a new low down to this low point here from the original Fibonacci we drew, then at one spot 333, whatever it is, and thereabouts. Yeah, I don't think the pound it's going to get down there. So I think any kind of opportunity where we spike down quickly on the monthly, weekly, or dailies and don't close towards them lows are good areas to buy. So you're looking to buy anywhere in this yellow box. Okay, this is no man's land. Yeah, this is where it's going to range. This is where it's going to consolidate. But if I think, with my fundamentals of interest rates going up in the UK first, and that the pound is actually, too oversold now, what I'm expecting to do is to hold above these lower fibs here, get back to this 38.2, get back to the 50%, and then probably, in time, get to the upper 61.8. So I'm expecting a low around about 150 in the pound. And then in the future, be it 1 month, 2 months, 3 months, 6 months, it's going to get back to 164. So getting into this yellow area here. Above that, it's going to get to 1.81. Yeah? So I'm buying in this yellow box here, if I'm buying a long-term trade, and I'm selling at this box here. Does that make sense? Okay, so weekly chart, again, we've dipped that down into this yellow area, so I think yellow area is good. Yeah, want to be selling it in the other yellow area. Daily, yeah, danced around this yellow area for quite some time here, but haven't gone lower. Yeah, certainly haven't attempted to make new lows. So once we break out of this yellow area, I expect quick, sharp buying to this other yellow area here. Okay, so take a screen print. Okay, take a screen print of that. That's Steve Ruffley's projections. If we get above 152, yeah, and hold above 152, I expect strong, sustained, and aggressive buying towards 163, 164, this other yellow area here. That's what I think is going to happen. Okay? Can't make it any clearer, any simple than that. So position at 150, looking for a tracement into 160. Is that too unrealistic? No, absolutely not. I mean, that's what I've just said. You've basically just mirrored what I've said. I think, it's this area here, this grey area, this black area of nothingness. We're on a downward trend, but when you look in the monthlies, 7 months of selling. So look at the dailies, looks like it's getting tired out to me. I've had this big gap and this sell down here, but bottoms going green. So I'm looking to break out of this area of downward movement, get positive, and then whatever the pattern is, at some point it might do this, it might do this. I don't know what it's going to do, but it's going to break out of this area of value here, and the next area of value is here. So this is no man's land. So if you're going to get long term, you've got to wait out whatever happens movement-wise in this, and then sell out when you get into the yellow area. That is my very, very strong view that, we're going to find a lot of strength, coming in the pound, to do with interest rates, to do with the strength of the UK economy, and nowhere else better to put your money. You're not going to put it in the euro. The dollar's massively high, so the pound is good value. So break out this yellow area, you get to that yellow area. That's what I think. All right, guys. Well, I hope that was interesting enough, and I hope Phil learned something out of that. It's always nice to have a bit of banter, isn't it? Right, so as I say, remaining strength in indices. Let's see if gold can get up to 50%, and that's a sell. The trend for the indices is still bullish, and until we hear any kind of other news-wise, then it's going to be. We've got non-farm payroll tomorrow, and that's going to be a massive, massive figure. It generally moves the markets, a lot. And with it being so high in the indices and being so high in everything else, it's going to be an interesting figure to look out for. I'm not expecting a great non-farm payroll, and even if it's stronger than expected, I'm keeping an eye on that hourly earnings rate, because I think that's the real factor behind what the Fed are trying to achieve, with rates and stuff. All right, guys. Well, listen. Anything else you want to know? Just get me on Twitter at Steve Ruffley. I'm always posting things on Twitter, trades, ideas, that kind of stuff. If you want to talk to me, just talk to me. I'm here all day. All right, guys. Thanks to FX Street, and thanks for everyone that attended, and I'll speak to you very soon. All right, guys. Good luck for non-farm payrolls, and I'll speak to you soon. Thank you.